That actually segues pretty nicely into the next thing I wanted to talk to you about, which is this really heavy correlation we've seen with Bitcoin and just, traditional risk on assets, especially just tech stocks. And I mean, when you just look at something like a correlation coefficient between BTC and the NASDAQ, we reached like an all time high correlation. I think it was 2 or 3 weeks ago. It's sustained at really high levels. So, like, do you think as Bitcoin, as you just mentioned, becomes more correlated with broader macro as it gets larger, do you think it just trades more in tune with what's going on in macro and that correlation with traditional just increases? Or do you think there is a case for potentially decorrelating from traditional assets over time?
So years ago, when Bitcoin was a smaller market, the group of people that traded Bitcoin and the group of people that traded every other asset was like two very different groups with minimal overlap. And so over time, as Bitcoin reached greater levels of adoption, both retail investors and institutional investors, that Venn diagram is kind of moving closer together, where the same people own both types of assets. Um, and so naturally, I think correlation increases in that regard, right? And generally, when Bitcoin is a liquidity play and a macro play, it's going to follow that kind of risk on, risk off things. And so with the stock market during rising PMI environments, you generally see the riskier stocks do pretty well. And during the declining PMI environment, that's when things like defensive stocks or gold or bonds generally outperform some of the riskier stocks. Now you always have exceptions, right? So in this declining PMI environment, instead of bonds doing well, bonds sold off because this was the first stagflationary declining PMI environment in a while. So there's always going to be curveballs. And so, a big question I had was how would Bitcoin hold up this time in a stagflationary environment? Because if you're going to have a decoupling, you would think that a stagflationary environment would be a decent time for it. So, you know, if you start to see margin pressure on companies and you see the Fed forced to come back and provide liquidity, I think that could be an environment where Bitcoin decouples favorably from broad equities because companies are basically forced to pay higher wages. They're forced, they have all sorts of struggles with their supply chain shortages, things like that. While Bitcoin doesn't have margin pressure, doesn't have employees to play, things like that. And so I think it can decouple when you have very specific conditions that are hurting stocks that are not necessarily hurting Bitcoin. So basically, if liquidity is positive but margins are not great, that should be at least a decent shot of a positive decoupling. But we're not there at the moment. Right now, we're still seeing liquidity being pulled out, and so you see a lot of correlations go to one. And so another thing that fed the whole correlation issue is macro because it's been an unusually strong macro environment. So you had the COVID crash, then you had the biggest liquidity bazooka we've ever seen, and so, the correlation of almost everything went up. And then as that liquidity bazooka is withdrawn, you see a lot of things roll over together. And so because we had a bigger than normal macro impulse, we have a bigger than normal amount of correlation. And I think over time that can separate. And things can separate in terms of size as well. And so, for example, you can say, okay, Bitcoin and ARK are correlated, but if you look at a 5-year chart, Bitcoin has killed ARK in terms of total returns. And that's because over time, one is getting structural adoption and the other one less so. And so you can decouple in terms of timing, or you can just decouple in terms of magnitude, where say up days you do a little bit better, down days you do a little bit better, and over time you slowly separate from weaker assets.
No, that makes a lot of sense. It almost, and this isn't like a perfect analogy, but in my brain, it almost reminds me of that visual that Ray Dalio uses for like the long-term debt cycle, short-term debt cycle, where, as you just mentioned, like in the long term, the thing that's really driving Bitcoin in a 5, 10 year time horizon is this adoption curve. And then on the shorter term time frame, you have some of these things that are driving the shorter term price action overlaid with that. No, I think that's super interesting. I honestly haven't thought of it that way before. So that's a really interesting framework.